Welcome back to Iron Financial. If you thought the first year of this administration was volatile, wait until you see what just happened. We are entering the second week of January 2026, and the rules of the game have officially changed. Normally, we wait for Friday morning to get the jobs report. We are waiting for the Bureau of Labor Statistics. But this past week, we didn't have to wait. In a move that shocked institutional algorithms and retail traders alike, President Trump took to Truth Social Thursday night, 12 hours early, to drop the employment numbers himself. The market reaction was instant. Algorithms scrambled. Treasury yields twitched. And by the time the opening bell rang on Friday, the S&P 500 and the Dow were already pricing in a Goldilocks scenario, pushing us to fresh record highs to close the week. But that is yesterday's news. You are here because you want to know how to make money next week. In this video, we are breaking down the massive rotation happening right now. We aren't just talking about the Mag 7 anymore. We are talking about a brand new Trump trade for 2026 involving nuclear energy. We are looking at a massive merger in the mining sector that nobody is talking about. And we are going to preview the bank earnings coming out this Tuesday that could dictate the next leg of this rally. Buckle up. Let's get into the charts. Let's start with the biggest story of the week. The convergence of big tech and big energy. For the last year, we have heard that AI needs power. We knew it was an issue. But this week, Meta Platforms, the parent company of Facebook and Instagram, stopped just talking about it and started writing checks. Meta announced landmark agreements with Vistra Energy and the advanced nuclear company, OKLO. Look at the reaction. OKLO shares soared 8%. Vistra jumped 10%. Why? Because this validates the thesis we have been tracking for months. The grid cannot handle the AI demand. Big tech has to build its own grid. And here is where the Trump factor comes in. Under a different administration, building new nuclear reactors would be a 10-year regulatory nightmare. But the Trump White House has made energy dominance a core pillar of the second term. We are seeing expedited approvals for small modular reactors, or SMRs. This is creating a deregulation premium for these stocks. It is no longer just about the technology, it is about the permission to build. And it's shaking up the leaderboard. On Wednesday, Alphabet, the parent of Google, officially surpassed Apple in market cap, sitting just below $4 trillion. Why? Because Google is seen as having better energy infrastructure for its AI than Apple does. Host, the trade for the upcoming week? Watch the utilities. Not your grandfather's utilities, but the AI utilities. Companies like Constellation Energy, ticker CEG, and Vistra, ticker VST. As we head into the inauguration anniversary, expect the president to tout these nuclear deals as American innovation. Any tweet, any Truth Social post mentioning nuclear or American energy could send these names flying again next week. Now, let's move to the sector that everyone loves to hate, until they love it. The small caps. For years, the Russell 2000 has been dead money. High interest rates crushed these smaller companies. But look at what happened last week. The Russell 2000 rallied over 5%. It is outperforming the S&P 500. This is the classic year 2 playbook. Historically, the second year of a presidency can be choppy. But Trump's policies for 2026 are heavily focused on domestic growth and deregulation. Who benefits most from deregulation? It isn't Amazon. Amazon has armies of lawyers. They can handle red tape. It's the $2 billion regional manufacturer in Ohio. It's the local bank in Florida. Small caps are purely domestic. They don't care as much about a strong dollar hurting exports. They care about tax cuts and less paperwork. We are seeing a massive rotation into financials and industrials within the small cap space. If you are looking for an entry, don't chase the tech stocks at all-time highs. Look at the Russell. Specifically, look at the interplay between yields and small caps. The 10-year Treasury yield has been stuck between 4.1 and 4.2%. As long as yields don't spike back up to 4.5, small caps have the green light to run. For the week ahead, keep an eye on the IWM ETF. If it can hold this breakout level, we could see a melt-up in junk names and high beta stocks. The market is widening out. That is a healthy sign for the bull run, but it means you need to rotate your portfolio. Don't just hold the winners of 2025. Look for the winners of 2026. Monday morning officially kicks off earnings season for the fourth quarter of 2025. And as always, the banks bat first. On Tuesday, January 13th, we have heavy hitters: JPMorgan Chase, Bank of New York Mellon, and Delta Airlines. Here is what you need to listen for. It's not just about the beat or the miss on the top line. It is about the guidance. The theme lately has been low hire, low fire. Companies aren't firing people, but they aren't hiring either. We need to hear what Jamie Dimon says about the consumer. Are credit card delinquencies rising? Are people spending their tax cut money, or are they saving it? If JPMorgan comes out and says the consumer is strong, that validates the soft landing. That validates the record highs. But, if they mention provisions for credit losses increasing, if they say they are setting aside more cash because people aren't paying their bills, the market could take a hit. Also, watch Delta Airlines. Airlines are the canary in the coal mine for the economy. If people are booking flights for spring break 2026, the economy is fine. If bookings are soft, we have a problem. My prediction? The banks will beat expectations. The high interest rates from last year allowed them to print money on net interest income. And with the yield curve normalizing, their lending businesses are waking up. Financials, ticker XLF, remains a top pick for this Trump trade continuation. Now, for the story that is flying completely under the radar. While everyone is watching Nvidia and Meta, a massive beast is waking up in the materials sector. Rio Tinto. News broke late last week that Rio Tinto was restarting merger talks with Glencore. Rio Tinto shares actually dropped almost 4% on the news, while Glencore soared in London. Why does this matter to you? Because this is a bet on the commodity supercycle. Think about it. We just talked about AI data centers. We talked about nuclear plants. We talked about electric vehicles. What do all of those things need? Copper, aluminum, lithium. A merger between Rio and Glencore would create a commodity titan unlike anything we have seen. And the fact that they are talking now tells you something about the regulatory environment. Under the previous administration, the FTC would have blocked this deal before it even started. Under Trump, M&A is back on the table. Mergers and acquisitions are going to be a huge theme in 2026. The under-the-radar play here isn't just buying Rio Tinto on the dip. It's looking at the entire copper supply chain. Look for the miners who have operations in friendly jurisdictions. We also saw that Trump granted an exemption for cathode copper from his tariffs last year. This administration knows we need cheap metal to build the AI infrastructure. If you are looking for a value play to balance out your high-flying tech stocks, materials, ticker XLB, or individual miners like Rio Tinto, look very attractive here. The market hates them right now. That is usually the best time to buy. So, let's summarize the game plan for the week of January 12th. 1. Watch the nuclear and utility names. Meta and Google have started a war for power, and Vistra and OKLO are the arms dealers. 2. Don't sleep on small caps. The Russell 2000 is breaking out. If yields stay steady, that is where the quick gains will be. 3. Listen to the banks on Tuesday. Jamie Dimon will tell us if the American consumer is actually broke or just complaining. And 4. Keep an eye on the miners. The Rio Tinto deal is a signal that the M&A floodgates are opening. The market is at all-time highs, but the leadership is changing. Don't get complacent. If you found value in this update, make sure to hit that subscribe button for Iron Financial. We are tracking the money, not just the headlines. I'll see you in the next one. The information provided in this video is for general, informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.